Morning, everyone, and welcome to another one in our series of BizTax Andersen webinars, where we are discussing cross-border tax with a focus on businesses. So today's topic is transfer pricing, and I've got a special guest with me today from the Andersen Montreal office. We have Elizabeth Roberts, who is a director in transfer pricing. Very happy to have you here, Elizabeth.
Nice to be here. Thanks, Namir.
So some quick housekeeping rules before we start. As you know, our webinars are now registered with the National Association of State Boards of Accountancy, NASBA. So it allows you to earn continuing professional education, CPE credits, by simply watching them. So to be eligible for these credits, please make sure you attend these webinars for at least 15 minutes, and you'll have the opportunity to participate in 3 polling questions. Following the webinar, our team will then send you the issue certificates over email, and that's to all qualifying attendees within a couple of hours after the webinar. We do appreciate your engagement and hope you find our webinars beneficial to your professional development. We will carve some time at the end of our webinar for some questions for the panelists. There's also a chat box that you can put your questions in, and we'll make sure to answer as many of these as possible. There's also a live transcript of the conversation Elizabeth and I are having. So if you click on the CC button there, you should be able to see the transcript of what is being shared today. And one last thing, we will send you a survey at the end, and these provide valuable feedback for us, and they also help us determine future topics you'd like us to cover in 2024. Now, look, this buildup that we've had in the BizTax series has really been around the life cycle of businesses that start to expand across the border. We've discussed, permanent establishment issues. What does it even mean to have a U.S. trader business? What is a U.S. trader business? And in our last BizTax, we dove into how to structure that cross-border business. And so really the next natural step for us, and this happens, kind of in the evolution of our client conversations that are in that space, is transfer pricing. And, Elizabeth and I have been in many conversations with clients that are really specifically in that moment and talking to us to plan it correctly. So without further ado, I'll let Elizabeth take us away.
Thank you, Namir. Appreciate it. Happy to be here. Hoping it was in person, but happy to do it virtually. So as Namir was saying, today's focus of the presentation is really going to be on transfer pricing. I mean, in the 50 minutes, hour that we have, we don't have time to, go through everything, but, we're hoping that at the end you walk away or you click that little X in our virtual world, but that you sort of end up with, a better understanding of what transfer pricing is, understanding some practical considerations if ever you are currently engaged in transfer pricing matters, you have intercompany transactions, and hopefully it'll provide you with a few insights just to take away, and hopefully better understanding of how to apply transfer pricing in Canada. So the agenda for today is we're going to take a quick look and overview of the Canadian and U.S. transfer pricing rules. We're going to look at some scenarios and some practical considerations. We're going to discuss at a high level the key differences between Canadian and U.S. transfer pricing, namely not in the rules per se, but in their interpretation of. And we're going to discuss transfer pricing adjustments and other tax considerations. And then just end off with a little note discussing Canada's modernizing and of the current transfer pricing landscape and rules in Canada. So just to kick off and to level set, our first polling question, our first question really is, have you ever dealt with, or are you currently dealing with transfer pricing matters? So this could be if you're involved in the preparation of transfer pricing documentation, the setting of intercompany transfer pricing policies, you've been part of a transfer pricing audit, etc. Just like to hear from you. So we'll give everyone a few seconds to respond. And I take it you, Namir, you're seeing transfer pricing more and more these days?
Well, it's interesting because I think a lot of times clients have heard of transfer pricing or they know some of the basics of what the expectation here is, but
Yeah.
really diving into this is kind of the first step as they're structuring their business when they have more than one entity in U.S. and Canada. So it's a great topic to get into.
Yeah. Perfect. So we see the results. So about half of you have been involved with it, and then there's sort of a split of no and not yet. Um, so that is great. So hopefully those of you that have been involved, you'll learn a few new things, and those who haven't, you'll, be in a better position going forward when that does happen.
Yeah, I guess, and that's a good question, Elizabeth, that you're asking, because I think, again, I think a lot of clients may have a basic understanding or an idea economically of
Yeah.
what is transfer pricing. But what does transfer pricing actually mean when you get
That
into
is
it?
a good question. So transfer pricing is the practice of establishing arm's length prices, right? So, that being said, what does that mean? Essentially, what it is when related parties, so, two entities that are part of a larger group are considered related for tax purposes, are transacting among themselves. We want to make sure that when they are transacting, they're transacting at a price at which they would have transacted had they been dealing with third parties. So it's really to ensure that each entity on each side of that transaction is properly reporting profits from a tax perspective. And transfer pricing was in Canada started in 1997, and it's originally designed to prevent tax avoidance, right? To avoid entities just shifting profits in one jurisdiction. It's now based on what you're contributing to that transaction, and you should be remunerated based on that contribution. So it's that terminology of fair share of tax that we've been hearing more and more, with BEPS and with the OECD. It's that concept of fair share of tax is, each entity is getting compensated based on, what they're contributing to that transaction. So in Canada, the Canadian transfer pricing regulations are contained in Section 247 of the Income Tax Act. It's not, the size of the Income Tax Act in Canada is quite large. Section 247 is quite small. And in there, it essentially says that the Canada Revenue Agency, or the CRA, adopts the arm's length principle. And the arm's length principle is sort of what it means. It's you're transacting at arm's length. Arm's length is that key term. It's as if you're entering into transactions with a third party. Because the regulations simply refer to that arm's length principle, there's a lot of administrative and guidance in Canada that's been written by the CRA on how to interpret what that means. So based on the nature of your transaction, based on your dealings, how can you interpret that meaning of arm's length in Canada? In the U.S., the Internal Revenue Code, Section 482, and then there's the Treasury regulations that come under there, are very prescriptive in terms of how, from a regulatory perspective, they deal and interpret that arm's length standard in the US. So it's similar to the arm's length principle in Canada. They refer to it as the arm's length standard, but generally it's similar, but on the IRS side, it's much more prescriptive. So all that being said, I guess, the question then becomes, if we take it sort of a bit more high level, is when we're talking about pricing intercompany transactions, what are intercompany transactions? So an intercompany transaction can be between two entities. I buy a good from you, or I'm selling you a good, right? It could be a widget, it could be a car, it could be anything. I could be licensing intangible property from you. So marketing IP, trademark, trade name, or it could be patent technology IP. We could also be where we're seeing more and more companies make acquisitions and then transfer IP out of a country into a different jurisdiction. Another thing we see often in terms of transactions, the provision of services, right? One entity could provide corporate head office management services. It could be contract research and development, sales support, sales and marketing, procurement services. There's a whole slew of services. There's also transactions from a financial perspective, right? So loans, intercompany financing, things like that, that are also impacted by transfer pricing. And then, there's the concept of reimbursement of expenses, where one entity will purchase something from a third party and then transfer that over and for being reimbursed of that third party cost.
And that's interesting too, right, Elizabeth? Because I think a
Yeah.
lot of times, especially in the formative years of building a business, sometimes the business owners aren't really thinking about that imaginary border. They're thinking, well, I'm just moving cash, or, I'm charging things between these
Yeah.
related party companies, but it's, all part of one common controlled group. So they're not really thinking like, why would I want to charge something at arm's length between these related parties? And this is where transfer pricing does come into play. And I know as this process gets more formalized, we get into the idea of telling clients that they need to have contemporaneous documentation. What does that look like, and what does that mean for clients as they're building their transfer pricing policy?
Yeah, so that is a great question. So we often hear that term, contemporaneous documentation, and essentially it's documentation because when you're entering into these transactions, right, and there are certain transfer pricing methods that are to be used in support of how you should price those transactions, and you're filing your tax return based on it. Under audit, the tax authorities want to understand, well, I need you to demonstrate to me how your prices are arm's length. And that's where contemporaneous documentation comes in. Contemporaneous means, it's on time, because in Canada and in the US, it needs to be in place at the time that you file your tax return. So it doesn't need to be provided to the CRA with your tax return. It just needs to be in place. So if ever they come back and say, I want to understand your transfer pricing policies, how they were set, demonstrating that they are arm's length and you paid your fair share of tax in Canada, that's really the role of contemporaneous documentation. And it helps mitigate potential penalties as well.
Well, that's I guess what I was going to ask you. Like, what happens if you have a client who says, well, you know what, this is pretty complex stuff right now for me. I'm just not going to deal with it. I'm not going to do any of this documentation. What are the consequences of not maintaining that kind of documentation?
Yeah. So, at a baseline is the documentation is essentially summarizing your transfer pricing analysis. So if when we're talking about often is that contemporaneous documentation, it's they don't have analyses and they haven't reviewed their transfer pricing. So it could mean that they're overpaying or underpaying tax in a certain jurisdiction, right? Which sometimes isn't quite ideal from a business perspective. But it's also being compliant that if ever you are audited and you do end up with, transfer pricing adjustments initiated by the government, if that adjustment meets a certain threshold, you could be liable to a transfer pricing penalty. And in Canada, that penalty, the threshold is an adjustment either greater than 10% of revenues or 5 million. And that 10% can, if you're small, that 10% can be reached quite easily. That you're liable to a potential penalty of 10% of that adjustment, which is not deductible in Canada. So it kind of does hurt. So it's good for planning. Potentially, transfer pricing is not meant to save taxes, but it helps plan your business in terms of who's doing what and how to properly compensate those entities. And the one last thing on this slide I just wanted to bring up is from a statute barred period is how far back can the CRA audit you for transfer pricing? Domestically in Canada, it's 7 years. Unless you're a Canadian controlled private corporation, then it's 6 years. But they can go back 7 years from the date of that notice of assessment that you received. So you can go quite far back. And often a lot of people move, people aren't around, right? In 7 years, there's a lot of movement of personnel. So if ever you are audited, the people who understood what was happening 7 years ago are now gone. So it's another reason why that contemporaneous documentation is important, because it, at the moment, it defines what the transactions were and how each entity contributed. And in the Canadian income tax regulations, they do specifically delineate what type of information needs to be in there for you to meet the definition of contemporaneous documentation. We haven't quite in Canada, they haven't adopted the master file, local file from the OECD, but that is something that as long as your documentation meets what the CRA expects there to be, then you're okay. But it does help in there knowing that they can go back 7 years. I mean, they typically will respect a tax treaty. So with the US, it's 6 years, but in 6 years, a lot of stuff can happen and people can move.
Now, Elizabeth, the idea of arm's length, like I know that means like it's a third party price.
Yeah.
That isn't necessarily a subjective test in terms of how you get there. That what are some of the methods that you would have to get to the arm's length third
Yeah,
party price?
so another great question. So a bit where you were saying is the concept of transfer pricing in theory is simple, right? I have a transaction, I just need to figure out what a third party would charge me for it, and that's what I'm going to price. And often in a multinational enterprise, and what you were alluding to earlier, it's in transfer pricing, we're looking at a specific transaction in an integrated business that you have. So one, we need to come and artificially extract that transaction, understand who's doing what relative to that specific transaction. So it's not always clear.
Yeah.
But from a transfer pricing perspective, there are certain methods that, exist that help determine, how to price. And so of those methods, there's some that are focused on price, profitability, gross margin, bottom line. I mean, I won't go through them in detail. If ever anyone has questions, we can walk through them. But at the end of the day, some methods are meant to be a bit stronger than others, but as long as they're reasonable and they're used from a reasonable perspective, then that's fine. But there are ways to help determine what that is. And often we'll hear like benchmarking analyses and comparable companies. And one of the methods is that it's going out and looking at public companies that may, perform those sort of transactions and enter into those transactions. I mean, yeah, perfect. So as I was saying, contemporaneous documentation needs to be put in place by the time you file your tax return, right? So that you're filing your taxes and what's being reported is arm's length. Although that doesn't need to be provided unless the CRA or the IRS requests it, there are some annual compliance forms in Canada that do need to be provided on an annual basis. And the first, which I assume most of you have heard about, is the CRA form T106. And that T106 is an information reporting form that essentially summarizes the nature of your transaction and what the quantum of that transaction is, and whether it's money going out of Canada or it's money coming into Canada. And so that the CRA does use that to a certain extent as a screening tool when they're, considering whether or not, they either want to audit or ask some follow-up questions around transfer pricing. And one of the key things on this form is the form does ask whether or not you have contemporaneous documentation in place at the time you filed your tax return. So it's a bit key here as to whether you answer yes or no. And it's keeping in mind that if ever you do get audited and there are adjustments, that potential penalty starts to come into play here if you have that documentation or not. And the other form is that country by country reporting form. It's really meant for large multinationals that have global revenues in excess of 750 million euros. And there's one entity within the group that files it. It provides some additional information on, intercompany transactions, the entities, a whole bunch of financial data, and then that's shared via government exchange. We tend to see that a little bit less as opposed to that T106, which we see a lot more frequently.
And I guess, Elizabeth, on the other side of that too, the U.S. has similar reporting with the 5472s and the 5471s. And, essentially like with the 5471, depending on the category of filer, will dictate what is required from a compliance perspective.
Mm-hmm.
And similar with the 5472, if you have any, related party transaction, you're reporting it there as well. And that can have as much of a $25,000 penalty for in terms of not getting it done in time or not having an accurate report done. But similar vein in that it actually provides the IRS with a bit of a roadmap in terms of understanding what are the related party transactions that are happening between the entity filing and related entities within that group. Yeah,
exactly, which is a great point. And, often we want to ensure that if you are filing a T106 on the Canadian and the 5471, 72 on the US side, you want to make sure that to a certain extent they match.
Yeah, exactly.
Right. And so it's there that sometimes they don't, and it can create some issues too of, are you in maybe a double tax position because you file different things on each side of the border.
That's a great point.
Yeah. So we do have here two polling questions, a little back to back, just around some questions specific to T106s, because this is something I think that most of you, at least those half of you who have responded that you have been involved in transfer pricing, may be questions that you've sort of asked yourself, or at least it's questions that we often get asked as service providers. So the first polling question, or the second polling question here, but the first in respect of the T106 is, does a branch need to file a T106 form? So if you're a US company and you have a branch PE in Canada, and you're transacting intercompany, if you exceed there's certain thresholds to have to file that T106 form, but if you do you need to file that form for a branch?
That's a great question, actually, Elizabeth. I was thinking about this when clients are coming to us, even on just the structuring questions. One of the things they ask is, do I even need to have a separate legal entity? So it's good to bring this up.
Yeah,
You even need transfer pricing before you've structured a separate entity.
yeah, exactly. And I think questions came in. So the majority of you responded yes. So in actuality, if you're a branch of a US company, you don't need to file a T106 with yourself, right? Because of a US company. However, it's a bit of a trick question, because if that US branch is transacting with other entities, then they would need a T106 for those transactions. But if they're transacting with themselves for those transactions, a T106 won't be required. But if they're engaging with anything else, they will. The one thing here to note, and a bit piggybacking off what you were saying, Namir, is even though you may not need a T106 with yourself, the concept of transfer pricing still exists, right? So it's that attribution of profit to a permanent establishment. It's a concept that we've been hearing more and more from the OECD, but even if you do have a branch in Canada, and often it comes, should I have a subsidiary? Should I have a branch? In either case, transfer pricing comes into play, because you still need to allocate some sort of profits to that branch.
And that would work, Elizabeth, for whether it's a branch of the Canadian entity or a branch of the US entity operating across the border.
Exactly. Goes both ways. Yeah, great point. So the second polling question, still around that T106, but it's a question we get asked often, is, as we saw quickly, but on the T106, it really breaks out all your transactions. So in Canada, the CRA is, focuses on a transaction by transaction basis. We don't aggregate and say, I might have 8 transactions with the US, I'm just going to show one amount. We really need to carve those out. So the question then becomes, if I have a number of transactions and, some are more material than others, and my contemporaneous documentation only covers a portion of those transactions, can I still answer yes to question 7 on the T106? It used to be question 6, but they've now revised the T106. It's now question 7. So can you respond yes? And the answers came back, and most people got it correct, that yes, if all material transactions are addressed, then you're okay. Then you can, feel comfortable to answer yes on that.
Great, and I think we're going to dive into some scenarios here that you typically see, Elizabeth, and
Yeah.
I'll kind of lay out the landscape for each of these scenarios, and we'll dive into the transfer pricing implications. So with this first scenario we have here, essentially it's a multinational group. So it's a company that is US based, but it has a Canadian subsidiary. And what they have set up is that they have salespersons that are providing, sales support services. And the salespersons, now they have this under the direction or guidance of the US entity. They're going to be tasked with promoting the product in Canada. So that could be, sales leads, cold calls, addressing customer inquiries. We see this actually quite a bit in terms of kind of the initial cross-border setup when you're doing business across the US and Canada. What does that look like from a transfer pricing perspective?
So great question. So to your point, that is what we see a lot of, especially it's kind of the first entrance into Canada. We'll start with salespeople. And, what we typically see is really, as you were saying, we've got a few people sitting in Canada executing sales activities on behalf of the U.S. So here, typically, from a transfer pricing perspective, and I will caveat that, transfer pricing, and determining what the best method is and what the policy, it's really based on the functions that you're performing, the risks that you're bearing, and the assets that you've employed and stuff. So here we're talking really sort of high level, and it's not necessarily a one fit for all. You'd sort of have to see with your fact pattern. But in cases like this, what we typically would see is Canco's rendering services, they're executing, they're not making any decisions, they don't have any risks, whether or not the leads pan out or don't pan out. Um, you know, they're sort of out of it. They don't take that risk. And so typically in these scenarios, we'll see that Canco is compensated with sort of a cost plus. So a reimbursement of their costs with kind of an arm's length markup, right? And it's a markup that, similar third party sales entities would have charged. The one thing here that, we often have to be careful of, and especially now in like a very virtual world where people are moving around, is there's often the risk of, just ensuring that those Canadian employees are, one, acting within the box that they're given, right? That they're not concluding contracts, they're not doing any other things that may change the characterization where they're no longer a sales support entity. But it's also ensuring that, USCO, when they are concluding those contracts, they're not on Canadian soil, and other things that could potentially create other tax implications like Ps and stuff like that. So, I think those are that's kind of a high level thing that we would see in these situations. So another scenario that we have.
Okay, scenario 2 here. So
Yeah,
this is, I guess, like stepping it up now. So this is
yeah,
where the multinational firm says, we want to have more of a foothold in the other country. So more than just a sales setup,
yeah,
they're going to have, again, same setup where you have a US company, but instead of just a sales function, now the Canadian subsidiary is going to be a distributor. So not only are they creating demand to sell the products in Canada, but more than just a pure sales entity, the distributor is actually going to purchase a product from the US entity and then selling it in Canada. So they're responsible for more than just sales activities, but also distributing the product. And I think, Elizabeth, you mentioned earlier that this could not necessarily just for the tangible good, this could also be for distributing, software or non-physical media
exactly.
in the
Yeah,
other jurisdiction.
yeah, exactly. And, more and more to your point, we are seeing a lot of that software. And so the concept of distribution of a good that's not physical sometimes is a bit harder to see, but this is definitely another scenario that we see, and it's really where the intercompany transaction becomes the U.S. is selling products to Canada, Canada's buying that product, and they're reselling it. And in terms of how Canada should be compensated for those activities, really depends on how much distribution risks are they taking, right? And typically, where you were saying, and kind of that slight step up from that sales support service provider is, Canco's going to buy the goods, they're going to resell, but they're really performing their distribution under the direction and guidance of the US. So they're not taking any material risks. They're kind of being sheltered, and a lot of that will refer to like a limited risk distribution profile. And in those limited risk distribution profiles, typically how we would see Canada compensated is we'll say, well, we're going to guarantee you an operating profit, bottom line. That operating profit is going to be benchmarked against, other distributors in that particular field, or industry, I should say, if it's pharma, if it's software, if it's in the auto, whatever it might be. And that sort of becomes, as Canco can then over time start to take on more risk, take on more activities, start to make more decisions, then that transaction will start to change and Canada's profile will change. And that will sort of, start to change the remuneration that Canada gets. The one thing here in these situations, where we, just want to, whatever Canada's profile is, if they're limited risk or they take on more risk and their compensation, maybe slightly different, is here you really need to make sure that you consider like customs and sales tax implications, right? Because transfer pricing is crossing a border, so you're selling a good. That sale of good is your customs value, right? Customs in Canada will, refer to, do you have transfer pricing documentation? What's your transfer pricing? So you just need to make sure that, and we'll get to it a bit later when we're talking about adjustments, but it's just something to keep in mind that that price that you're setting from a transfer pricing perspective will impact other areas of tax. And
all right, scenario 3. So scenario 3, I guess we're diving into a bit of a different industry here. So here you've got a U.S. multinational group, but the Canadian subsidiary is set up to do contract services on behalf of the U.S. entity. So that could be, providing any sort of development services for the IP. But again, similar to scenario 1 and 2, it's really still under the direction and lead and oversight of the U.S. entity.
Yeah. So these types of services, we tend to see a lot of like contract R&D service providers on the eastern side of Canada, right? Ontario, Quebec offer really great R&D tax credits, et cetera, and other programs like that. So we tend to have a lot of that on the eastern side of Canada. Not that you guys don't on the west, but it is something that we see, and so it's a model that we often see as the IP owner sitting somewhere else in a different country. And they're, setting up a service provider in Canada because we have a lot of talent here, and there's some great shred credits, tax credits, et cetera, to get hold of. So, we set up these entities, and typically these entities, similar to the sales entity, they're executing, right, the direction of the non-resident entity and stuff. And so as long as they're playing within that box, what we tend to see as a transfer pricing policy is Canco receives kind of a cost plus with an arm's length markup, and that arm's length markup is likely different than that markup that we would see from a sales support service provider, right? Because the nature of the activities are different. The one sort of thing here to keep in mind from a Canadian perspective, and as I was, saying earlier, is Canada has a lot of administrative guidance interpreting in its interpretation of how it, wants to see transfer pricing applied. And when it comes to entities, especially in the R&D field, that are getting tax credits and receiving government incentives, they really expect that the benefits of those incentives stay in Canada. And so it's just something to keep in mind that when you are setting up your policy of cost plus, if that fits that fits the terms and conditions of your transactions, just something to keep in mind on how you're dealing with any tax credits, et cetera, that you may be receiving. And we're happy to talk about that in more detail if that is something that you're entering into. So now that we've kind of looked at different scenarios, we just wanted to quickly talk about some practical considerations, and namely some differences between Canada and U.S. And, as I was mentioning earlier, the concept of arm's length principle, arm's length standard is relatively similar in both countries. It's more in their application of it where it kind of differs. And, the first is the burden of proof in Canada. And, those of you who are Canadian, and, I tell this to a whole bunch of people, but, Canadians globally are known to be very nice people. But our tax authority, the CRA, is known to be one of the most aggressive tax authorities in the world, right? Because for, whatever reason, they're tired of being stepped on or wherever it goes. And so the burden of proof on a taxpayer in Canada is much higher than on the IRS, right? It's as if they always, and maybe it's my interpretation based on, the number of years I've been doing this, but it's as if, things are always being hidden from them, and, they're getting the short end of the stick. So there's a huge burden of proof on the taxpayer in Canada. So it goes back to, your question on contemporaneous documentation. Have that documentation in place. It gives the CRA a starting point. Have legal agreements in place. It gives them a starting point. It's then up to them to refute it versus you having to change, where the CRA is going. Another sort of difference is around tax authority requests. So, Canada, U.S., you prepare your documentation. You don't need to give it to the tax authority until they ask for it. In Canada, if the CRA asks for it, you have 3 months to provide it. In the U.S., you have 30 days. So, your level of ability to do stuff is slightly different in Canada and U.S.
Is it,
Sorry, go
I
ahead.
was just going to ask, is it fair to say it's probably really difficult to do a transfer pricing study in 30 days to
Yes.
turn it around?
Especially if they're going back 6 years and no one
Yeah.
who was there 6 years ago was still around. It's very difficult. Yeah, it's very difficult. Good question. So the other bigger difference in the application, anyone here who's, reviewed TP reports or done benchmarking analyses, one of the big differences that we see more often is in Canada, we look transactions by transactions, year by year. The IRS will allow the aggregation of certain or the bundling of certain transactions. I mean, it always depends the case, obviously, but and they and they'll look at it sort of on a multi-year basis. The CRA doesn't like multi-year, so they will look at things on a year by year. So when you are entering into transactions and doing documentation and benchmarking analyses for a Canada-US transaction, you want to make sure that from a Canadian point of view, you're falling within the full range of that single year. And in the US, you're falling within the interquartile of the 3 year. So sometimes it's a bit of a play, but it's just something to keep in mind. And another thing that the IRS has that Canada doesn't quite is, the US with their services cost method is they allow for like ancillary low value back office, type services that they can be recharged at cost without a markup. In Canada, if you don't want to charge a markup, your burden of proof is much higher. You really have to demonstrate why that's appropriate. Okay, so we'll go through these a bit quickly. I'm running a bit out of time. So some practical considerations in Canada is, I already mentioned it, but it's the importance of legal agreements, right? It sets the intent of the parties at the start of a transaction. The terms and conditions, and it really sort of starts off that transaction and it helps shift that burden of proof back to the CRA. The other part that I mentioned too is, in Canada, we really look at it on a transaction by transaction basis, which makes it very difficult sometimes because you're artificially extracting transactions out of an operation. And so one of the hard parts with that is you really need to be able to get good segmented financial information, right? So for each transaction, we need good segmented information. And I say that's probably one of the toughest things from a Canadian perspective, that Canadian and U.S. companies and other companies is having to go in and figure out how to segment their financials into these transfer pricing transactions. And then, going back to that treatment of government incentives that we, brought up quickly in our example on the R&D side is just to consider that if you are benefiting from tax incentives or government incentives, I should say, how are you dealing with those from a transfer pricing perspective? And just a few more, considerations is from a Canadian, from a US perspective as well. So when your intercompany transactions involve the payment of royalties, right? So the use of marketing IP or technology IP, there is withholding tax that's applied on certain types of royalty payments.
Mm-hmm.
And with the Canada-US treaty, it's marketing IP, so royalties on marketing IP, trademark trade names do have withholding at a treaty reduced rate, but there's withholding. But there isn't necessarily withholding. It's reduced to zero on sort of patents, know-how, and things like that. And a lot of taxpayers, when they are paying royalties, we tend to see a lot of bundled IP. And so you may be overpaying on that withholding tax if in that bundled IP, you do have some know-how and patents. So it's sometimes something to consider of if it's material enough, should we figure out how to bifurcate that royalty? Other items are, transfer pricing follows your operations. Transfer pricing doesn't decide what you're going to do. We follow your operations. And so it's important that if there are any changes, those changes will have a direct impact on your policy. And so transfer pricing is meant to be looked at on an annual basis. And I, will always tell people that I work with, be involved in transfer pricing from the perspective of, has anything changed in the business? Because you would be surprised how sometimes it's yes. And I'd say in the last number of years, people working virtually from different countries, all of a sudden you're not aware from an operations perspective that people are crossing borders and working, but there's a direct impact on not only TP, but certain tax matters as well. And, I already brought up the sales tax customs implications. It's just something to consider that TP, the pricing has a direct impact on those as well.
That was a great point earlier too, Elizabeth. I think,
Yeah,
often when we're dealing with clients, if they do move forward engaging us to help with their transfer pricing analysis or study, the
yeah,
reality on the ground is their business is growing, their business
yeah,
facts and circumstances are changing. And so
yeah,
having that transfer pricing done, study done, in a certain year will match the narrative of what's happening in that specific year for that set of
exactly.
facts and circumstances. But as
Yeah,
that changes, your analysis might change, or your perspective on what's the right arm's length pricing will change as their business grows as well. So you want to make sure that's
exactly.
always aligned.
Exactly. And, to that point is sometimes it does impact other tax things as well, right? You've got people crossing the border to render services. Well, now you might have, Reg 102, Reg 105 issues. And so it's often in transfer pricing discussions that, we'll sit there with the tax manager and they're like, whoa, I didn't know about this. Like, no one told me about this. Like, I've got other issues I'm responsible for, but no one told me, right? So it's there that it's always good to have your ear to the ground. So we come to our last polling question. Um, and the question is, do you or have you ever performed transfer pricing adjustments in respect to your intercompany transaction? So, you know, transfer pricing adjustments can take place weekly, monthly, annually, however it is. But we just want to understand here if you've ever performed any.
And I guess, Elizabeth, I know you're going to dive into that here shortly, but the
Yeah.
timing of the adjustments makes a big difference too.
Yes, it makes a huge difference. Exactly. Yeah. And we'll get to that, what the pros and cons of that timing are. Exactly. That's why people either love transfer pricing or they start to have nightmares if it's coming on their plate.
We got a mixed bag there.
Yeah, yeah, we do have a mixed bag. Um, so for those of you that have, hopefully this will be informative, and those of you who haven't, at some point, if you are, then it's just something to keep in mind as you go. So as Namir was saying, there are different types of adjustments and the timing of those adjustments is important. So we have sort of a concept we kind of refer to in transfer pricing as a taxpayer initiated adjustment. So it's a taxpayer who, is looking at their transfer prices, they've got intercompany transactions and they need to make adjustments. And, often, we may set a transfer price at the beginning of the year and say we're going to continue that all year. But often in the business, things happen, right? Something happens in the market, something happens globally, something happens in the company where, things shift and we don't end up where we want to end up at the end of the year. So, we make transfer pricing. Either it's at year end, or it can be at the time that the tax return is filed, where often, as we're preparing that transfer pricing contemporaneous documentation, we're doing our analyses, we might sort of say, oh, well, you're within the full range in Canada, but in the US, you're not within that interquartile. So we're going to need to just maybe shift a few things to get you there, which could also create an additional transfer pricing adjustment.
Well, what about if the taxpayer decided they were going to initiate those adjustments after they filed the tax return?
Yeah. So if you do it before, things are good. If you do it after, where we see a lot from a Canada-US perspective, because the Canadian return, with the US extension, the Canadian return is due a few months before the US return. And so in Canada, as long as you do your adjustment before you file that tax return saying, I'm properly reporting on my tax return, everyone's happy. If you do it after, the CRA does not allow you to do a downward adjustment. So to lower the taxes paid in Canada after you file, so you can't amend if it's related to transfer pricing. So often we may end up in a double tax perspective. Now, there are certain avenues to try to get that back, right? But it's, the minister who needs to decide, like, it's not something it's very offhand, and if it's a very specific particular circumstance that they may allow it, but generally they don't allow it. So often there we end up sometimes with sort of an economic double tax, right? Because the US needs certain level of profitability. Canada's now overpaid. I can't get that back. Um, and the other item is, you know, from a upward adjustment is if we say, oh, we didn't leave enough profit in Canada, well, the CRA is not going to say, don't amend to pay me more tax. But the issue there becomes that if ever you are audited and the transfer pricing adjustments exceed that threshold for the transfer pricing penalty, you've just told the government that, hey, I didn't do what I was supposed to do when I was supposed to do it. So you may, you know, the penalty may be applied. Not saying that's going to happen, but it's kind of something to keep in mind. You really want to make sure that when you file that tax return, that your transfer prices are properly reported.
And I guess, Elizabeth, because transfer pricing is inherently complex,
Yes.
as you well know.
Yes.
What are the avenues that could be available then to taxpayer if they say, whoops, I didn't do this right? What are some, avenues they can do to fix that, if you will?
Yeah, that is a very good question. I mean, you know, depending on the materiality of, you know, whoops, I didn't do it well, is, you know, from a Canadian perspective, like I was saying, right? Like you're working within a range. So as long as you're within that range, the problem is if you filed, if it's something material and if it's for a very specific circumstance, a request can be made to the minister. So years ago, the voluntary disclosure program used to
Mm,
be available for transfer pricing. It no
got it.
longer is, unfortunately. So that's one of the big things in the last few years that's made a big impact is for transfer pricing adjustments, that voluntary disclosure is no longer there.
Got it.
You know, but there are other avenues, you know, depending on the materiality, you know, Canada offers different programs like the advanced pricing arrangement, right? Where for any year that is still is not statute barred and that has yet been audited by the government, you can apply for an advanced pricing arrangement and roll back, right? So you could roll back those years to say, well, I know as of 2022, I haven't been audited, the year is still open. I can apply for an APA. The government, like the two governments, negotiate those things, but you would be allowed to roll back years to change that filing position.
And that's
So
taxpayer initiated.
that's taxpayer initiated.
Got it.
Exactly.
Got
Now,
it.
from a tax authority initiated, which is the other perspective, is, you know, if ever you're audited, you could be audited in Canada. Well, that's going to create an adjustment if they feel, you know, you didn't properly report, or the US may audit and say, hey, you left too much money on the table in Canada. We want that back. That then triggers an audit. So the US will do an audit once, you know, the reassessment is
Mm-hmm.
issued.
Mm-hmm.
Then because it's transfer pricing, you have access to competent authority, right? So competent authority can then, you know, negotiate, you know, whether or not you want to trigger an audit to help you with your, you know, isn't necessarily where you want to go, but if ever you are audited, that too could help clear things up. You just lose
Got it.
control, right? Because it's now in the hands of the tax authority. So it's not necessarily where you want to go, but a tax authority audit, you know, could also sort of correct things from a government perspective, at least. Yeah.
Got it. Got it.
Um, and I guess one of the, you know, last thoughts here is really around, you know, I think one of the biggest things we see in transfer pricing and we kind of forget and, you know, can create issues is every time we make these adjustments, it could have an impact on customs and sales tax, right?
Mhm.
So when you're declaring your customs value at the border, it's based on the value at that time. If you're making adjustments a month later, 2 months later, 6 months later, year end, or at time of tax return, you have to remember to go back because that customs value needs to be changed. And so it's often just keeping in mind that
Wow.
if it is, you know, a good transferring and there are customs implications, then you need to, you know, talk to your customs broker, whoever's helping you with that, just to say, hey, I've adjusted my transfer price. Do we need to do something? And it's the same thing from a sales tax perspective, right? You've paid sales tax on certain amounts. If those amounts get adjusted based on transfer pricing adjustments, you also need to go back. And from a
Quite the domino
withholding
effect.
tax perspective, pardon me?
I'm saying it's got quite the domino effect in terms of the
It
impact.
becomes quite the domino, and so it's really not, it's just, keeping in mind that it's something very specific but could have broader implications. And,
Mhm.
these are just sort of high level insights or thoughts, things to keep in mind. I mean, it can get very complex, and that's why, people like you and me are here, is to help go through, but it's often things that, you and your business as a tax manager or whatever, your business better than we do. So sometimes it's just keeping in mind that, if you're aware that you do these things, it's just note that a change on one side could impact the other side. Yeah.
One more
And I
second.
see that yeah, sorry, go ahead.
No, I think we got time. Go for it.
Yeah, very, very quickly. For those of you who may or may not be aware, in June that just passed, the Canadian government Department of Finance came out with a consultation paper asking advice from stakeholders in respect of Canada reforming and modernizing their TP rules. So they sort of came out to rewrite sections of 247 with a bigger focus on economically relevant conditions. So kind of that substance of, it's fine that, you've got a legal arrangement in place, but is the conduct of the parties actually following that arrangement, right? And giving a mechanism to the Canada Revenue Agency to adjust. Um, and part of that is they came out with different ideas from an administrative perspective on how to maybe make things a little bit, I'm not going to say user friendly, but a bit maybe simpler. And, parts of it is saying, okay, well, should we look at perhaps adopting the local file concept that Canada hasn't quite adopted, that a lot of other countries have? Looking at simplifying the administrative burden around documentation for lower value transactions or smaller transactions. Um, coming out with something maybe similar to the U.S. services cost method, right? For certain things where, we're kind of simplifying those things. So I don't want to get too much into it. If you guys have more specific questions, feel free to reach out. I mean, it was, quite a large thing, but it was just that you're aware that this is coming, it's happening. It's just another step towards, you know, transfer pricing continuing to be important and to being on the forefront. And, money is tight. It's not only in our pockets with groceries, right? It's sort of from a government to government. And, transfer pricing is kind of that tug of war, is how every country within a, where multinational operates, is who's going to get what share of that $1. And so they're going to get more and more aggressive. And, so we're going to, I think, start to see more audits, more disputes, and this, reforming and rewriting of the laws is just going to allow the CRA with a bit more flexibility to be able to do that, as opposed to in the past. Yeah.
Fantastic. Thanks, Elizabeth. I think that really is the great way to kind of close it in terms of the next steps and where we see things going with transfer pricing.
Yeah.
And I think what we'll do next is now we're going to dive into some questions. Let's for the next I think we've got 7 minutes.
Okay. Thank you, Namir and Elizabeth, for the webinar on the transfer pricing with a lot of information today. So we do receive a couple questions from the audience. The first question is, what kind of documentation needed for the CRA purpose on transfer pricing for the reimbursement of expense type of transaction and the dividend type of transaction?
Yeah, so that's a good question. So, on that T106, we'll see that reimbursement of expenses, and we had talked about, an intercompany. So the nature of a reimbursement of expenses is, in of itself, it's a third-party cost that I'm recharging you and you're reimbursing me for. So in terms of documentation, you can't get better than that arm's length third-party price, because in theory, that reimbursement of expenses is it's an actual third-party cost that I am just recharging to you. So in terms of that documentation, it's just to have the backup of, where that cost came from and how that cost benefited the entity you're recharging it to. So, one thing that, we'll often see is, multinational, it could be insurance, which may have sales tax implications, but, we're recharging insurance across different entities. It could be an SAP license, it could be IT fees that, are coming from third parties. And So your documentation is really going to be, you know, those third-party invoices, how it was carved out for Canada and how it benefited Canada. I would say, you know, generally, you know, should be sufficient for that.
Thank you. And the next one on that, the CRT 106 form, the
Yeah.
transaction are reported based on the cash or accrual basic.
Yeah, so, you know, you want to make sure that your T106 aligns with your trial balance and with your tax return. So, you know, that's really how you're gonna account for what you're putting in your T106.
Thank you for that. And the third question is having a U.S. officer sign a contract for the U.S. call and a Canadian officer sign contract for the Can call primary because of the transfer pricing or because of the permanent establishment consideration of both?
So I'm not sure I understand the question 100%, but from what I understand is you've got signing officers in different countries signing on behalf of other countries. So, you know, part of it is need to understand, you know, what the characterization of each of those entities are, right? Is it, I guess, a third party distribution contract that we're signing, and, you know, who's entitled? Like, are you signing it on behalf of yourself as a U.S. company on Canadian soil or a U.S. officer? I mean, part of that, and that's maybe a question we can take online with a few more specifics just to better understand the nature, but there could potentially be permanent establishment issues depending on, you know, the nature of the agreement that you're signing, where you're signing it, and on behalf of who. Yeah.
That's right, Elizabeth. Yeah, I think just to kind of add a little bit more on the establishment side of things, you know, when you have a lot of times when we're talking to clients around whether it's transfer pricing or other, you know, cross-border tax implications, you know, we do want to see that you're delineating what's happening, for example, in the U.S. entity versus what's happening in the Canadian entity. You don't want to start crossing border in your transactions unless it's intentional. And so from the perspective of signing contracts, if you're an officer of the company, I think, you know, if you are concluding contracts on behalf of that company as a, you know, you're essentially a dependent agent of the company, you will be binding that entity. So if it's the U.S. entity, you are binding the U.S. entity for those contracts, and where you do that. And by the way, it's not just like a rubber stamp thing. It's not like, okay, well, I've stamped this in Canada, so it's done in Canada, but it's where all the decision-making happens to, you know, accept or even reject that contract. Like you might look at, I don't know, the creditworthiness of that client and say, hey, you know what, this is not the right client we want to have. So those are things that also tie into your permanent establishment questions as well.
Yeah, thank you for that.
So the next question is, what are some features of the most useful transfer pricing contemporaneous document? So
here, if I understand, it's type of information that should be included in the documentation. Okay, So from a Canadian point of view, and, you know, I'd say it's similar to the U.S. and other countries. There's no specific format in Canada on how to compile your documentation as long as certain factors are included. They're in section 247.4, but in a nutshell, it's, you know, what's your intercompany transaction? What are the terms and conditions of that intercompany transaction? Who are the parties to that transaction? So, you know, what entities, what countries are we talking about? How are they related? And then you're going to have what we refer to in transfer pricing as a functional analysis. So on each side of that transaction, or you know, if we're talking about that transaction, who's performing what functions, who's bearing what risks, and who's employing what assets, right? And then that kind of sets up the economic analysis to determine how you're going to test. So the economic analysis is going to go through, you know, the transfer pricing methods, which method was selected as, you know, the best method to determine and test the transfer price that you use. And then you're going to have like a financial analysis essentially that needs to tie right to your tax return to say, you know, here's what I made, the profitability or the price that was used, and, you know, it aligns with the economic analysis.
I think we're getting here pretty close to the hour. So I just want to say, Elizabeth, thank you so much for joining us today from the Montreal office. We really value your expertise in transfer pricing. So thank you so much. And One last thing, as we mentioned earlier, we are going to send you a survey if you've attended us, the webinar today. We really value your feedback. Your feedback helps us shape what the next webinars look like, what topics to cover. So thank you for joining us today. And please do fill out that survey. And again, Elizabeth, thank you.
Thank you, everyone. Appreciate it. Cheers.